Hello, and thank you very much for taking your time out of your busy schedules to join our latest IGM webinar. My name is Matt Barrett, and I am a senior analyst, part of the European credit team. And I am joined today by my colleague Robert Martin, who is a US based investment grade analyst, and also Carlos Yon, who is our emerging markets analyst in New York. Today, myself and the guys will be having a look at November credit market trends across the US, LatAm, and European regions. And we'll be looking to see what impacts the decisive win for Donald Trump at last month's presidential election has had on primary bond activity. And we'll also have a look ahead to 2025, which is now, of course, only around the corner. Not quite sure where that's gone. Before I bring in Robert and Carlos, I just have a quick look at the IGM data, and it shows that primary bond activity on both sides of the pond, really, since the elections has continued at a brisk pace, as has been the case, should I say, in the whole of 2024. We've seen bouts of volatility persist all year with various well-known factors at play, whether it be political or geopolitical uncertainty, some mixed corporate earnings, or changes to monetary policies. But throughout 2024, we've seen the investment grade market, especially both sides of the Atlantic, remain pretty resilient. Markets have been very quick to reprice at times if needed in response to any outside influences. And we have seen the issuance window wide open more often than not. Just taking a top line view, and the European investment grade market is seen as about 15, just shy of 15% supply increase year on year, whilst in the US IG space, we are running an even higher, sort of 26% ahead of 2023's pace so far this year. On that note, I'll bring you in now, Robert. First of all, thanks very much for joining me on the call. Of course, the election has had impacts across the financial markets, but just over in the US investment grade bond arena, what's the picture like there in terms of like the run up to the vote, and then obviously what we've seen since?
Yeah, thanks for having me. So, as expected, the IG new issue market in the States slowed to a near standstill during election week, with only $1.9 billion priced in new debt. While Trump victory appeared to be largely priced in, there was still some uncertainty remaining due to historical precedent. What followed once market intuitions were confirmed, however, exceeded even the most optimistic expectations. Over 96 billion was priced in the 2 weeks following the election. That's more than the entire month of October combined, where we only saw 95 billion.
Well, yeah, it's been a very similar story in Europe. We've shown resilience again all year, right? Going into election week, we thought, as many of us did, with what the polls were saying, we could be sort of in for a bit of a lull, bit of a a slowdown for maybe a week. But with such a quick result, we were open for business fairly quickly. I think it was the Thursday after the election, we saw a number of euro trades and sort of issuers make the most of what were solid conditions in the wake of the sort of Trump trades that were going on elsewhere. Most active in Europe post the election have been IG corporate names, which have flooded the market and helped bring the year-to-date single currency haul across all asset classes up to 1.472 trillion. That's only been topped on an annual basis by 2020's 1.484 trillion, when issuance hit an all-time high amid the COVID-19 pandemic. We will struggle to hit that, of course, given that there are only a couple of lowly supply weeks of December to go. But the solid volumes in recent weeks, both since the election and beforehand, it's going to continue into January, it looks like, at this stage. While I say it's been busy, which it of course has, overall volume for the month of November actually finished only a shade over 60 billion to make the lowest monthly total of 2024. And 50% of that was corporate names, as I said. But the slowdown is not necessarily a surprise, given that we're at the beginning to wind down for the traditional festive break, whilst a number of issuers, especially in the SSA side, had already completed their sort of 2024 issuance requirements earlier in the year. Just to bring you in, Carlos, whilst the IG markets, both in the US and Europe, have sort of been active of late, has it been the same in the LatAm market?
Well, Latin America has been somewhat slow in the month of November. There was one trade, um, which was sized at almost 177 million, which is not a large bond by any market standard, and that pushed LatAm issuance for this month to slightly over 4 billion. So that is on one hand a slower pace of issuance, but that's to be viewed only because September and October combined for almost 29 billion. They were very busy months following the end of summer lull, and even though November issuance has been somewhat slow, this more moderate pace of issuance is taking place within the context of a year of recovery. Latin America saw two very lean years in 2023 and 2022. Um, Not even 50 billion in 2022, a little better last year at almost 75 billion. Now this year, LatAm already has slightly over 111 billion. And these were the numbers that LatAm was more accustomed to earlier in the pandemic and even pre-pandemic. So again, this is a year of recovery and of a comeback for LatAm.
Yeah, thanks very much there, Carlos. I mean, obviously, we said earlier, Robert, I mean, the US volumes have been huge. Have we sort of seen the investor demand there to back that up?
Yeah, so for most of the year, corporate spreads have remained relatively tight. However, on the first day after the election week, spreads hit a more than 20-year low, trading at just 77 basis points over comparable treasuries. While they've since widened slightly, the overall trend remains lower than average corporate spreads in the US IG market. And despite this surge in supply, investor demand overall has remained robust. As shown in the chart here, the average new issue concession for the month is below 2, which is significantly under both the yearly and second half averages right now. Coverage ratios, they tell a similar story as well. We're hovering around the yearly average and exceeding last month's levels, even as a month that saw lower issuance.
Yeah, I mean, as very, very similar story again in Europe. I mean, the amount of parallels that there is at the moment is very much a sort of robust market. I mean, it's been a seller's market or an issuer's market, whichever way you want to phrase it, but not just in terms of size of paper being able to be issued, but also in terms of the order volumes, order book volume, should I say, and also the modest premiums again that people are willing to expect. Um, I mean, we had the new issue concession remain in the low single digits across all Euro deals to price in November. Um, and we've also seen sort of the average cover ratio on the European side was almost 4 times, and that was in November, and that was the highest since June. On a potential note of caution, there was some noticeable attrition in some of the order books, especially towards the end of the month, where some corporate and financial investors pared back orders after issuers cut significant pricing during the execution process. But at the moment, I mean, with that 4 times cover ratio, it's not really a problem yet, but potentially something to look at going forward. Um, just sticking with Europe for now, and I mean, one thing that has been notable this year is the influx of US borrowers, corporates in particular, that have tapped the euro market and printed what the so-called reverse Yankee bonds. I mean, in November alone, we saw several names tap the market both into and after the election, and we raised a combined 7.5 billion to make it 2024's second biggest month of reverse Yankee supply, having only been beaten by a massive 18 billion flurry in May. I mean, and IGM data shows that year-to-date reverse Yankee supply stands at a shade over 60 billion, and that has only been beaten by two previous years, and that was namely 2022 when nearly 64 billion was issued, and the record of just over 99 billion set in 2019. That all-time figure of almost 100 billion in 2019 came amid a collapse in reverse Yankee sales seen in 2018, linked to the Trump administration tax changes that were seen as increasing the appeal of bringing home cash held offshore to invest instead of tapping bond markets. I mean, given that Trump is now back in power, any policy changes that could impact reverse Yankee issuance will be closely scrutinized. But I mean, we expect US corporate issuance in Europe to be high going forward into 2025. Just going back to the States, Robert, whilst we've seen US names cross the pond and tap euros quite a lot this year, have we seen domestic names active in the US investment grade market too?
Yeah, so the Yankees have definitely been active on our side of the pond as well. They played a significant role in the post-election rush, with 14 Yankee deals being priced in November, 10 of which came from Yankee banks. So definitely playing a role. Another angle that I felt is important to kind of bring up under a new administration is the mergers and acquisitions front. Activity has picked up overall this year, but we've seen 4 M&A deals priced since Trump was elected, 6 billion worth since the election, just over 6 billion since the election. As the year winds down, we've only got a couple more weeks of issuance, but we're not far off from the 172 billion priced in 2021, which was the post-COVID year that had pent-up demand from both sides. So it'll be interesting to see if we can get to that level. It's important to note that the Biden administration blocked several notable deals this year, including the U.S. Steel Nippon Steel merger, Capri Holdings Tapestry deal, and the JetBlue Spirit Airlines merger, among many others. It's hard to imagine a scenario with tighter regulation under a Trump administration, and we're betting on less regulation. So this could pose a significant tailwind for deal making in 2025, and we think that M&A deals can kind of lead some volumes next year.
Yeah, that's definitely something to keep an eye on, I think, going forward, over in Europe as well. I think we could see the more US companies come over here to do that sort of activity rather than take it all out in the dollar market. But just on terms of next year, I mean, Carlos, are we expecting a bit of a pickup in LatAm supply in 2025? And are we going to get off to a fast start in Jan?
Well, let me answer you first by talking about January. January is always the busiest month of the year. This year, January had over 31 billion, and that was the second busiest month of all time, behind only another month of January a few years ago, which saw 37 billion. I would say that prospects for issuance into 2025 look solid. Neo Kashkari over at the Fed said yesterday that it appears reasonable at this time to continue lowering the federal funds rate when the Fed meets one final time next month. And with further rate cuts and lower borrowing costs as a result, I do believe that LatAm credits will be more willing to come to market, even though they did a lot of that this year. Now, as for January itself, LatAm has a number of issuers that we call them informally the frequent flyers. They tend to be stubborn issuers such as Panama, Paraguay, Colombia, Chile. You also have large oil names such as Pemex and Petrobras. But I am very much looking forward to deals by two very regular frequent flyers, and they are Corporación Andina de Fomento. They've come to market in January the past 4 straight years, and the undisputed champion is Mexico. Mexico has come to market in January for the past 9 straight years. This year they did 2 bonds, one in US dollar, one in euros, and the total combined that's Mexico sold through those 2 deals was almost 10 billion. So I would be very surprised if Mexico stays on sidelines next month. I'm sorry, not next month, in January.
And obviously, I'm going to ask you a bit of a vague question here, Robert. I mean, on the US investment grade side, I mean, what are you guys looking at heading into not just January, but obviously into 2025 as a whole?
Yeah, so right now, while some of Trump's economic policies pose a degree of uncertainty, the market appears pretty confident that his more extreme protectionist stances can be kind of moderated and walk back a bit. Just last week, U.S. Treasury yields saw their largest single-day drop since August after Trump appointed Scott Bessent as Secretary of the Treasury. He's seen widely as a stabilizing figure with the potential to temper some of these protectionist policies. And while we have yet to conduct our 2025 issuance poll, preliminary conversations that we've had indicate that the street is expecting ex-SSA issuance to top this year by another 15 to 20%, as long as market conditions remain conducive to raising capital as they are now. And again, another mention for M&A, we're expecting less regulation. That should also drive volumes and get us to that 15 to 20% higher level this year or next year.
Yeah, I mean, in Europe, I mean, we expect another bump here as well. I'm not sure we're going to quite hit those heights of as much of an increase as you guys think, but I mean, we never know. A number of corporate issuance, especially, they've already sort of pre-funded 2024, early 2025 issuance projects over the last few weeks of this year. But I mean, there's a host of factors which support a sort of prediction of another busy year. We've got a lot of redemptions coming up next year, which will need to be refinanced. I mean, the significant levels of cash on the books of many corporates due to large funding around the COVID-19 pandemic have now been depleted, so they might need to be replaced. We feel like the falling rates and improved access to financing should help the M&A market as well as anything that comes from the US. And I mean, the tight credit spreads are probably going to encourage more to go. And we could even see that push maturity boundaries with cheaper funding potentially there. We expect no time to be wasted in January. I mean, as you said earlier, Carlos, it's very, very similar on the IG side. January and September are busiest months of the year. And it's going to be probably the automakers on the corporate side and the usual sovereigns that are going to be amongst the first to go. Just on the SSA side for a second, just sort of before we sort of think about wrapping this up, the recent sort of significant moves that we've seen in the Bund swap spreads, I've seen sort of the 10-year Bunds trade that negative swap spread still needs to filter through to the pricing of SSA secondary bonds. I mean, the primary market, as is often the case, is a sort of great vehicle for doing so, as it sort of clears prices before some clues as to where things could actually be trading. I mean, for now, as we head into January, the more liquid names such as KfW, EIB, and the European Union are likely to be used as a barometer of fair value until we get back into any sort of meaningful supply. Well, I'd just like to say thank you for everyone attending this webinar, and we hope it was useful. I mean, if you have any questions, and please don't hesitate to reach out to myself, Robert, or Carlos, either via email or Bloomberg. And again, thank you very much for your time, Robert and Carlos. And we wish you all a Merry Christmas and a prosperous New Year.
You too. Thank you.
Thank you.
Thanks, guys.